Bitcoin, the first and most well-known cryptocurrency, has had divided opinions since its inception in 2009. One of the most persistent criticisms is that it functions similar to a Ponzi scheme. But to understand if it's really a Ponzi scheme, let's first take a look at what exactly is a Ponzi scheme. A Ponzi scheme is a fraudulent investment operation that pays returns to its investors from funds contributed by new investors. There's no underlying investment or economic activity generating these returns. Instead, the scheme relies on a continuous influx of new money to sustain payouts to earlier investors. This unsustainable model inevitably collapses when new investor recruitment slows or ceases. The key characteristics of Ponzi schemes include guaranteed high returns. So essentially schemes that promise a very unrealistic returns with little or no risk. Secondly, the lack of transparency. The investment strategy is shrouded in secrecy, and the financial records are generally unavailable, so investors don't know how the money has been made. The third one is difficulty exiting the investment. Investors may find it quite challenging to withdraw the funds that they invested in this scheme. While some aspects of Bitcoin might appear superficially similar to a Ponzi scheme, closer examination reveals significant differences. Now, here's a breakdown of the key points of differences. Firstly, with regards to returns. Bitcoin's price is highly volatile. There are no guaranteed returns. Investors can experience significant losses. Secondly, with regards to transparency, the Bitcoin network is transparent. All transactions are publicly recorded on a distributed ledger called the blockchain. So anyone can verify the network's activity. Lastly, in terms of liquidity, Bitcoin can be bought and sold on cryptocurrency exchanges, providing investors with relative ease of entry and exit. Unless, of course, if the exchange closes down for reasons such as bankruptcy or whatever, and they prevent the customers from withdrawing the funds like FTX did, which is terrible. Yeah, so that is definitely an exception, which is why it's recommended to always keep your crypto in a cold storage. Proponents of Bitcoin argue that Bitcoin possesses fundamental value beyond just relying on new investors. Essentially, new investors investing money and pumping the price of Bitcoin. They believe that Bitcoin has inherent value. And some of the points that they talk about is the idea of scarcity. There's a finite supply of 21 million Bitcoins programmed into the protocol. This scarcity provides scarcity value to the asset of Bitcoin, known as Bitcoin. So this is similar to precious metals because they're limited in supply, hence the price of it will increase with time. The second aspect that they argue for is that Bitcoin as utility. It can be used for online payments, albeit with limitations due to its volatility, as well as that transaction fee that you have to pay when you transfer from one wallet to another. The third point is that Bitcoin can be seen as a store of value. Some people view Bitcoin as a hedge against inflation. Similar to gold, Bitcoin is also known as the digital gold. The limited supply and the decentralized nature of Bitcoin offers potential protection against the traditional financial systems. The Federal Reserve is the central bank of the United States of America. They wield a powerful set of tools to influence the economy, primarily through interest rates and liquidity. Let's talk about interest rates. The Fed sets the federal funds rate, which is the benchmark interest rate for overnight loans between banks. By raising this rate, the Fed makes borrowing more expensive, which essentially slows down the economic activity and also combats inflation. Conversely, lowering the rates encourages borrowing and investment. This stimulates the economy, which means that when the Fed increase the federal funds rate, risky assets such as Bitcoin are sold off to reduce volatility. Hence, this influences the Bitcoin price to reduce. Conversely, the price of Bitcoin has historically increased when the federal funds rate has increased. This is also true for other assets such as the S&P 500. Right, let's talk about liquidity. The Fed can also influence the money supply by buying and selling government bonds in the open market. When the Fed buys bonds, it injects new money into the financial system. Hence, this increases the liquidity. Conversely, selling bonds reduces the money supply, hence tightening the liquidity. So when new money is injected into the financial system, risky investments such as Bitcoin are bought up because of the increasing in purchase power of those entities that are buying the asset, which increases the price of Bitcoin as well. Conversely, when the Fed sells their bonds, money supply reduces and Bitcoin is sold off to reduce volatility in the asset's own, hence to reduce the risk of loss. In conclusion, when investors perceive tighter financial conditions, they may become more risk averse and they sell their Bitcoin holdings, potentially leading to a price decline. Conversely, looser monetary policy with increased liquidity can create a more optimistic investment environment, potentially boosting Bitcoin's price. So the bottom line is this. Essentially, when there's a reduction in interest rate and when there's an increase in liquidity by the Feds, it's good. It's good for the price of Bitcoin and it pumps. So as long as America is the global superpower and the dominant currency that's used for trade is the US dollar, I don't think this trend will go away anytime soon.